It is officially, actually we're running a minute late, 8:01. So, today's topic is pretty much disposition versus renovation. So one of the things, whenever you own a property, that you're always trying to wrestle with is, how long should I hold this property? You know, how many years? Should I hold on to it forever? Should I hold on to it for some sort of a predetermined fixed period of time? When should I sell it? How much should I sell it for? What are some of the implications of selling it? That's what we're going to be dealing with today, okay? And so, whenever you go to buy a property, you know, what kind of expectations do you have? I mean, in other words, do you go into it thinking, I'm going to own this thing for some sort of a predetermined number of years? Do you think you go into it just sort of like, okay, I'll sell it whenever I feel like it? I mean, what do you think you would do as an investor? Any ideas? Whenever you're going in to buy a property, do you think you go in with some sort of almost a predetermined, I'm going to own this property for 5 years, or I'm going to own it for 10 years, or I'm going to own it for some other period of time until maybe the market changes, or you know, whatever. I mean, what is it you think you would go into a property sort of ownership situation sort of thinking in that respect?
Well, you always hope there is appreciation.
Okay, so one of the big things that you're hopefully banking on is there's going to be some level of price appreciation. Okay, that you're going to be able to sell it for more than you bought it for. Okay, but how else do you make money off of real estate? Price appreciation is one.
Rent increases.
Okay, the rental income or the operating income. Okay, now you can also make money off of some of the tax sort of benefits that you might receive from owning real estate. Okay, but another thing that people don't inherently just automatically think about. I mean, they do if they're sort of an experienced investor and they're really sort of thinking about the implications of this, is something we call equity buildup, okay? And this, very simply put, is if you have a normal loan on a property, just a normal, fully amortizing mortgage, you're going to be paying down the balance on that mortgage over time. Yes? Okay. Well, as you pay down the balance on that mortgage, that in essence is what we refer to as equity buildup. Okay? In other words, you're paying down the principal on the mortgage. All right? So that over time, obviously, you're in essence gaining equity in the property, okay? Now, an example of where that does not happen is with like an interest-only mortgage, okay? Because with an interest-only mortgage, you're not actually paying down the principal balance of the loan. You are simply making interest payments on the loan with no reduction in the balance on the loan. So there is no equity buildup. In other words, with an interest-only mortgage, if you bought the property for $100,000, have a $100,000 loan on it, 10 years later, you're still going to owe $100,000 on that mortgage with an interest-only mortgage. But with a normal mortgage, 10 years later, you have paid down something, okay, on the balance of that loan where you're going to be owing less than the $100,000 that you originally borrowed. Does that make sense conceptually? Okay. So, one of the things that you begin to think about in this whole kind of disposition versus renovation decision is you probably need to take a good look at what your equity buildup is going to be in the property at any particular point in time. Now, the question, which obviously translates into sort of a test question, that sort of thing, is how do you go about calculating what that equity buildup is in the property? All right, so give me a loan amount. 200,000. Okay, give me a loan term, a number of years.
30 years.
Okay, 30 years. Okay, give me an interest rate.
5%.
5%. Okay, so let's start with this. All right, let's assume that it's a monthly mortgage, 12 payments per year. All right, so 200,000 is our loan amount or our present value. 30 years or 360 months is our term. 5% is our interest rate. So the first thing we need to do is calculate the payment. Okay, so let's do that real quick.
1,731.
Okay. All right. 1,073.64 is the monthly payment. Okay, so nothing new here so far. All right. Now, let's say that we hold this property, or we're anticipating holding this property for 5 years. Okay, what is going to be our equity buildup over that 5-year period? Okay, now in this particular instance, first of all, I haven't given you what?
Growth rate.
No. No.
The term that we're gonna hold it.
No, I just said 5 years. What have I not given you?
Future value?
No. 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 Well, okay. Not percentage that you're paying, but how much you're actually,
The LTV.
The initial output.
well,
The equity?
yes, your initial equity, and, because this is obviously just what? Just the debt piece,
Right.
okay?
The
So
loan to value.
$200,000 loan may be on a $250,000 purchase. Does that make sense? So you've already got, in one sense, if you sort of look at it, a $250,000 purchase minus the $200,000 loan or debt means you've already got $50,000 that you've put in initial equity in the property. Does that make sense, everybody? Okay, so I would have to, in essence, give you that. Or in the absence of giving you that, then you just have to assume what? It's all debt. Okay? All right, now, after 5 years of ownership, I'm asking you, what would be the equity buildup in this property? All right, let's just see if you can think through how you might approach it.
After 5 years, the principal that you've been paying over the last.
Okay, it's going to be the principal that you're going to be paying over that 5-year period. But how are you going to get at that information?
Amortize it.
Okay, you're going to use the amortization function on the calculator. Okay, so
So you take the principal minus the 200 and then plus the 50,000.
no.
It's gonna
So what you're going to do,
add.
you're going to use the amortization function. So in this case, 1 input 60 for 60 months or 5 years, shift, amortization, and then you're going to hit the equal key. Okay? Now if you do that, it gives you 16,342.54. And that is what? The principal that you have paid on the loan. Okay, that's the answer we're really looking for. But if you hit the equal key again, what does it do? It gives you the interest piece, which we don't need for this problem, but I'm just going to go ahead and write it out anyway. 48,076.06 is the interest. And then it also gives you the balance. If you hit equal again, 183,657.46. Now, once again, if you're just doing the basic math, if you take 200,000, subtract out 183,657, you're going to get the 16,342. Okay? Because that's the amount that you have paid off of the loan. This is the amount that you still owe on the loan. Okay? Does that make sense, everybody? The distinction. Okay? So, simple question. What is the equity buildup in the property?
66,342.
Okay, the total equity buildup would be taking the 50,000 here, adding it to the 16,000, so your total equity in the property is now 66,342.54. Does that make sense, everybody? Yes or no? Okay, so all we're doing is we're simply taking that 50,000 plus the 16,342.54. Okay, and so that would be the total equity buildup in the property. Okay, make sense, everybody? Yes or no? Okay, now once again, what is the significance of this? Why do we care?
Cost of capital elsewhere.
Okay, part of what we're going to concern ourselves with is as time progresses, we're going to have more and more equity build up in the property. Okay, meaning that if we were to sell the property right now, there's more cash that in essence we're going to be able to take out of the property. Does that make sense? We're going to be able to cash out more of the equity of the property. And we have to begin to ask the question, what would we do with that equity if we cashed out of the property? Where would we put it? Okay? If we have no other place to put it, we might as well leave it in the property. But if we have other investment alternatives that are going to be potentially yielding a higher rate of return than leaving it in this property, we have to begin to sort of explore that. Does that make sense? Because, I mean, you know, the mindset of some investors is, okay, look, I want to own this property, I want to own it free and clear, have no debt on it whatsoever, and then just earn the operating income off of it year after year after year. Nothing wrong inherently with that strategy, except could they be cashing out of that property, parlaying that money into another property that potentially is yielding a higher rate of return? Does that make sense, yes or no? Okay, and that's where this whole sort of disposition versus renovation thing comes into play, because one of the ways that you escalate your net worth by owning and investing in real estate is through financial leverage. And specifically, it's being able to borrow money and control assets that are worth potentially millions of dollars with a relatively small upfront sort of equity investment. Well, if you own a property and you continue with this equity buildup over time, you've got to make the decision, have I got too much money tied up into this property that I could be putting to a more productive use elsewhere, is the point. Because you could also, there's another way you potentially would have equity in this property, and that is, what if the market value of the property changes over that 5-year period? You may have bought it for $250,000, but what if 5 years from now, or 5 years later, the property is now worth $300,000? Okay, so in essence, you could say, what? If the property is now worth $300,000 5 years later, based on the market value of the property, in essence, that's really saying you've got another $50,000 potentially of equity that has been contributed to the property. So in this case, we've got what? 116,000? Does that make sense? So in other words, if we were to sell it, is my point. If we were to sell it after that 5-year period, we would be able to, barring taxes, barring transaction costs, barring, you know, all of that sort of stuff, we'd be able to walk away with really $116,000 that we could then do what? Plow into another property. Because if we just kept this property, what are we getting? We're just getting basically, or it's costing us, this $1,073 a month, but the reality of it is we're gaining equity. This is sort of paper value, if you will. Because the only thing that we're really going to be generating off of it is whatever rental income the property has during that ownership period. And the point here is if you could cash out and take that $116,000, keeping in mind that originally you only invested $50,000, and you more than doubled that over a 5-year period, that could be an awesome play for you to be able to make and find an alternative investment. Does that make sense? Yes or no? Okay, so that's one of the things to put in the back of your mind. Okay. Now, to kind of help us with this a little bit, we probably need to talk about something called a marginal rate of return. Okay? A marginal rate of return. MRR. Okay? Now, if we're sort of looking at this kind of graphically, and your book does a great little example of this, what you've got here on the x-axis is time. Okay, in years, months, whatever it is. So we're going to say time in years. And on the y-axis, we've got the return, percentage return. Then what we're plotting on this graph, a couple of different things. One is we could have what we're going to refer to as maybe our hurdle rate, okay, or our required rate of return, all right? And let's just say that that stays constant. So we can call this, once again, our hurdle rate, or required rate of return, or we can also call it our reinvestment rate. Basically all the same sort of thing, okay? And we'll just say, maybe we'll put that at, this is 10%. Okay, where it crosses over. So what we're saying in this particular example is over time we are perfectly content with getting a 10% rate of return on our investment. Okay, does that make sense to everybody? Yes or no? But whenever we invest in a particular property, what we might find is a relationship that looks something like this. Okay? Now, what would you think that represents?
The equity buildup.
Well, it's not just the equity buildup, it's also what we're going to refer to
Minimum increase.
as our marginal rate of return. In other words, from one year to the next, we are looking at, in essence, the profitability of owning this property for yet another year. In other words, one could say, what is the maximum return you're receiving on this property? Well, obviously here at the height of the curve, yeah? But is that where you should sell it?
No. It's just still above your return rate.
Exactly. So when should you sell it?
Below.
Whenever it crosses over, right there. Okay? Now that seems all very logical, and it is. But you know what you've got to do if you're going to have that sort of discipline, if you will, as an owner, investor, is that you've got to sort of know, what is my hurdle rate? You know, when am I going to finally sort of say, all right, this property is not making as much money as it was, and time is progressing, I've got more and more repairs I'm having to do on the property, my rental income is not as high as what it used to be, but at what point do I finally, you know, pull that trigger? And you've got to have the discipline to be able to say, all right, we see it, it's rapidly approaching, you know, sort of the hurdle rate in terms of the decline, it's probably time to get out of the property. Now, does that necessarily mean that you've got to wait until it gets precisely there? Not necessarily. Okay, and I think you guys are going with this. Because in this case, we're making the assumption, as I said, this is your only alternative, okay? It's either getting the rate of return on the property as it's above the hurdle rate, or you have other opportunities that are available to you that are equal to or greater than the hurdle rate. Does that make sense? Now, what could happen that makes this much more complicated is, what if there are other investment alternatives that are out there that over time that you could begin to explore, and then you've got to sort of say, well, is their rate of return, if I were to cash out my property now, would I be able to invest in those? Okay, does that make sense? Is that kind of where you guys were going with
I have
it?
another question, is because obviously the depreciation is kind of consistent. Can
Yep.
you sell it to another common, I think it's called a common interest entity, and then start the depreciation process over?
Yeah.
You can. And adjust the depreciation.
Whenever you sell a property to another individual,
Even if it's your own company, just a different, that's what
that's a little bit
Like
more of a
another
problem.
entity.
It's got to be an arm's length transaction.
I'm saying. Okay.
You know, if it's just simply you're selling it back to yourself in some way, unless there's, let's put it this way, the IRS would probably look fairly scant at that kind of behavior, and if they were to figure out that that's
Even if you
probably,
pay taxes on the whole transaction.
it's, all I'm saying is I wouldn't inherently advise it,
Okay.
okay? You might be able to get away with it, but I wouldn't inherently advise it, okay? Now, all right, other question, Brianna?
No, I was thinking like, if you're gonna get to that point, if you're gonna sell it, also, it doesn't probably gonna look appealing to other investors.
Okay.
So that's why.
There we go. Okay, this is the part that begins to make this a little bit more interesting. Why might another investor look at this differently? Or how might they look at it differently? In other words, you've owned it for 5 years, okay? You've done whatever you've done with owning and managing the property over 5 years. New investor comes along, new investor has a fresh set of eyes, they look at the property, and what?
You may see an opportunity.
They may see an opportunity that you don't see. Like repositioning the property maybe in a certain way. That you've always thought of it as being for this particular use and this particular type of tenant. But someone new coming into that market may say, wow, I see a totally different use for this property, and so therefore they can reposition the property, and by virtue of the repositioning, may be able to get higher rents than you potentially were expecting that you would be able to get, and maybe even with renovation cost, it might make sense for them. Does that make sense? Okay? Perfect case in point are things like Wynwood. You know, I love to use Wynwood as an example in Miami, because what was it for many years? A warehouse district, okay? Full of a bunch of just empty, non-really overly income-producing warehouses, okay? And then the Goldman family comes in at some point and does what? They say, hey, these warehouses are pretty darn close to downtown. Huh, I wonder if there's some value there. Okay, what might we be able to do with these warehouses? So what was the initial thought? Okay, we turn them into sort of artist studios and artist lofts and other sort of sort of entertainment-ish venues, start creating a lot of foot traffic, and you're able to do what? I'm sorry?
Create value.
Create value, okay? Whereas it's no longer inherently being used as industrial space or warehouse space that is probably among the lowest rent generating sort of type of property historically, and you're all of a sudden turning it into much more of an entertainment type of district that's going to have a much higher rent per square foot. Okay? The value creation comes from that repositioning. Does that make sense? Or you turn it into residential, or you turn it into some other mixed use sort of opportunity that has a higher price point in terms of rent.
Did they do a complete overlay there, or is it parcel based?
They bought a pretty significant number of the properties, and then as a result of buying enough properties, were able to then to, in essence, sort of create the, I guess, the critical reinvestment necessary to reposition it. I mean, buying maybe that one solo property probably is not inherently going to be enough of a stimulus to pull people, down there. But, buying up 10 or 20 properties, all within close proximity and being able to kind of create the look and the feel of things.
But the city didn't overlay, or did they rezone?
They did rezone. They did rezone
They
a
did
lot of it.
rezone.
Well, usually, one of the things to sort of point out with industrial districts, as a general rule, is they are the most intensive. Usually, industrial districts are probably the most intensive of uses that a local government will allow. That pretty much within an industrial district, most local governments will say anything goes. And so, having said that, in many cases they will say, yeah, if people want to actually live down here, and they know that it's an industrial district, they know it's kind of, dirty, grimy, nasty, whatever word you want to use, that's okay with us. But for the most part, that's just, it's one of those sorts of things that that's where a lot of the value creation comes into play, is finding kind of those repositioning sort of, I wouldn't close that one over there too if I were you.
No.
But there's no airflow at all on Saturdays. Yeah, so, okay. So does that make sense? Now, another sort of thing to think about in this kind of acquisition and sort of repositioning is, within some of these kind of areas, like what we talked about with Wynwood, it's especially interesting if you can buy properties at below replacement cost. Now think about what I just said. If you can buy a property below replacement cost, what does that mean? That means you're buying it at a price point that if you were to tear it down, you could not rebuild it for that same price. It would cost you more to rebuild it, okay? Well, in that sort of an environment, you say, well, how does that exist? Well, it exists when you may not have any available tenants for that particular product type at that particular point in time. And in many cases, this is where these types of neighborhoods that have fallen into sort of disrepair and decline, this is where the real opportunities are. I mean, virtually all the purchases that I made in doing real estate investments have been these kind of opportunities where you buy in a distressed area, you basically take that property, you transform it in a way that takes it from what its previous use was into something that has real market value. one of the first properties that I bought back in the 1990s was a building in a downtown area that was a two-story, what we'd sort of call a shotgun building that had been built in the late 1890s, which is almost 100 years old, basically, whenever I bought it. And two-story building, original use, and actually even emblazoned on the back of the building, saloon, okay? Right next to the railroad tracks. It had gone through a number of uses, being a saloon and a whorehouse in the late 1800s, all up through Prohibition. And then subsequent to that had been transformed into retail, and then just became storage space, and then it was just empty for years. I came in, bought the property for next to nothing, and immediately said, hey, there's a market here for loft apartments. So let's take this building, transform the second floor into loft apartments, transform the first floor into office space, and overnight you took a building that was worth virtually nothing and magnify the value 4 or 5 times, you know, the original value, without really doing anything other than repositioning it into a use that was actually in demand.
Did you have to change windows?
I had to change quite a few things, but one of the things that was interesting is that one of the reasons why it had sat vacant was in this downtown area, there was no demand for retail. And everyone in their mindset in that area was like, oh, this has to be retail. And so all the owners of the properties in the area were like, oh, this all has to be retail, but we can't find any retail tenants that want to occupy it. Well, that's not where the demand was. The demand was with office space because you were a block away from the courthouse. So attorneys wanted office space. Demand was you were 4 miles away from the Texas A&M campus. People want housing, and especially in cool, interesting spaces. Okay? So, you know, transformation like that. So once again, you take a property, reposition it.
Do you buy the property right after the crash of the 90s, or?
It was like 98. Yeah. But anyway, so the point being, that's what you should be thinking about. You know, so the question was, you know, how is it that someone new, potentially looking at it, would be able to do something different? Because a lot of the existing owners, in a lot of these cases, have held the property for so long that they just simply don't have that creativity, or they don't have that sort of ability to really think about it in those terms. Okay? Make sense? Okay.
So your advice is pretty much buy a property when you see blood in the streets, right?
Exactly. No, I mean, the best time, I mean, if you think about it, if you buy a property under normal market conditions, you're not going to get a bargain. Most players in the market that have been in the market for a significant period of time are always going to be waiting for the market to crash, and then that's when they buy. Because that's when the extraordinary opportunities begin to emerge, you know, because fundamentally this business is all predicated on what? Buy low, sell high, okay? And if you buy it at a low enough price point, and then you can hold on to it and afford to hold on to it maybe for a couple of years until the market begins to recover, and then you can do whatever it is that you want to do to transform the property, whether it's to renovate, whether it's to build something brand new there, whatever the case may be. You've got a much greater chance of success than if you had bought it at the normal prevailing market price, where your initial investment was going to be dramatically higher.
Right.
Okay? And so if you think about it in those terms, you know, very simply put, you know, if my cost basis as an owner investor is at $50 a square foot for the property as a whole, but your cost basis for the same identical property is maybe $100 per square foot, what am I able to do that you're not? I'm able to charge much lower rents. Or I can charge market rents and get a much higher overall rate of return than what you're going to get. Does that make sense?
Yeah, makes sense.
Okay. Okay. Now, one of the things that you've got to do to begin this analysis is that you've got to sort of look at these sort of decisions, first of all, really on more of an after-tax basis. Okay? Not so much on the before-tax basis. One of the mistakes that we traditionally make in real estate, especially with things that are what I would call on the margin, is that we look at things just strictly on a before-tax basis. There are benefits and there are detriments to potentially looking at the property or evaluating the property or calculating the returns on it on an after-tax basis. Because the before-tax sort of rates of return don't tell the full story, is what I'm suggesting. And so that when you're making these kinds of decisions, there are other factors at play. Like, for example, with a renovation decision, one of the things that you might be or might find available to you are tax credits for renovating historic properties. Okay? And those tax credits only benefit you on your after-tax cash flow. They don't benefit you on your before-tax cash flow. Okay? So, ignoring them, you might automatically assume bad investment, bad deal, would never do it. But on an after-tax basis, you look at it, oh my gosh, this is great. Look at these tax benefits that I'm receiving from basically renovating this property that's a historic property.
Can you double dip on the 20 and the 10? Because a lot of the historics can be 4 to 36.
Yeah, so what Noah's getting into, you have a couple of different sort of levels of tax benefits. And you have a 10% and a 20% tax credit, depending on the conditions of the property. Okay? Now, if you take a look specifically, if the property is placed into service before 1936, you automatically get this 10% tax credit. Whereas if it gets to be a certified historic structure, you can get a 20% tax credit. Okay? Now, what does it mean to be certified as a historic structure? Each state in the country and at the national level will have a certification process where they will say, they will have a team of individuals that will go out on a, kind of a requested basis and say, hey, I own a property. I would like to see if you would be interested as a state or federal agency to, in essence, designate my property as a historical structure. You know, it was built before, let's say, 1936, and it has some sort of interesting story behind it, and so there's a reason to save it for, perpetuity, okay? And so in doing that, it's not a guarantee that they're going to confer that certified sort of historical structure designation on you. It's something that you have to potentially apply for. But once it's done, it's almost impossible to undo, okay? And you're saying, okay, well, once you've done this, a subsequent owner is stuck with it.
For like 30 years, right?
Pretty much almost forever, okay? That because the idea behind having it designated that way is that there's something worth saving. And they go through this whole process of determining, why is it worth saving? And in some cases, it not only applies to a specific building, but maybe an entire neighborhood. I'm sorry? I'm sorry?
Fort Lauderdale.
Why?
Oh, okay. That might be, I'm not familiar with it, so I don't know. But as a general rule, what happens there, if you're an owner within that particular area, usually, you have to gather together all the owners, and then they potentially, will go, have to participate in a number of meetings, and you've got to get buy-in by, overwhelming majority. I want to say maybe the percentage is like 80% or something like that of the owners have to kind of buy into this, because at some point, one of the owners might just simply say, I don't have anything to do with this historic district. And now many of you would say, well, why? Well, because it would preclude them from potentially changing their property. Like, for example, if all of a sudden they want to change maybe something about the exterior of the property, maybe so simple as changing the color, okay, or changing the roof, or changing the windows, they would have to go before the local historic commission to effectively get approval. Okay, so it adds an extra layer of bureaucracy and an extra layer of regulation that may preclude the owners from being able to do things with their property. Some of the properties that I owned in this downtown historic district, we had to go through all sorts of things that every time you wanted to modify the exterior in any way, this is what I'm saying. If you want to repaint the building, you got to get permission from the approved set of paint colors. Anytime you want to change out the windows, you had to get approval to get a specific type of window with a certain type of glazing, with a certain type of frame, and so forth, so on, to go through that whole process.
What about the use?
The use is not as much of an issue within the historic district, because their whole purpose with the historic district piece is really, it's about the appearance. Okay, not so much the use. And in some cases they go so far as to saying, and there are a couple of really interesting examples of this, in a lot of different places, but in downtown San Antonio, they have this one particular facade of a building. The facade was saved, that's all that was saved, and then a high-rise building was built behind it, okay? Because the building itself was completely unsalvageable, but they saved the facade, okay? Does that make sense? The front of the building. That's all that was saved. And then you built a modern skyscraper behind it, kind of thing, okay? But the idea was you preserved what was there. So my advice to you, in terms of as future developers, you gotta be very careful about these sort of tax credit programs. They sound great and they can be great, but usually with anything that comes from the government, there are strings attached. And the strings attached potentially are going to be additional cost to actually come into compliance with their standards in order to qualify for that tax credit. Now, without getting into all of the nitty-gritty detail on these, one of the interesting things that you will hear about, and that happens quite often with these, is the developer selling off the tax credits to corporations or high net worth individuals. And you're saying, huh? Well, one of the things that you are allowed to do, both with these historic tax credits as well as things like low-income housing tax credits, is as the owner, developer of the property, you have the ability to sell those tax credits to individuals with higher tax rates.
Once they build up, right?
Right, that once the property is built, okay? And
No, I mean, once you start building up the tax credits, right? Or
well,
doesn't work like that?
once the property is built, then in essence, you're going to be receiving those tax credits incrementally over the life of the project.
And when you have enough, that's when you sell, right?
Well, you can sell it up front though. Okay, and then they will simply pay you maybe a fixed price lump sum up front
Right.
for that sort of an annuity, or they will pay you in essence on a year by year sort of basis. But in most cases, they'll just simply pay you sort of an upfront lump sum a discounted value of what those are worth to them.
Future tax.
The future tax
And
liability.
that's because of the dollar to dollar.
Exactly, because a tax credit is different than a tax deduction. A tax credit, make sure you're clear on this. A tax credit, as Noah said, is a dollar for dollar tax payment reduction. Or not deduction, reduction. Whereas,
So that means the same amount of tax credit you sell, that's the same amount that the corporations deduct?
No, they deduct.
it
from the
depends,
bottom,
the
whole
On the
amount,
bottom?
the amount that they get to deduct is determined by their tax rate. Whereas you, let's say, hypothetically, as a developer, your tax rate might be 20%. Their tax rate might be 40%. So there's a 20% differential there. So there's that differential of 20% is worth money to them because they can get more of a benefit from it. Okay, does that make sense?
Yeah. So they basically can potentially deduct those 40%,
Not deduct,
um,
reduce
reduce.
their tax liability.
It's better to reduce than to deduct.
Because a deduction is different. A deduction simply reduces your taxable income.
That's more for like operating costs and
Yep,
things like that.
exactly. Yeah, operating cost, repairs and maintenance, interest deductions, those are all tax deductions. Okay, if you remember, our little tax subroutine that we did, we said net operating income minus interest expense minus depreciation gave us what? Taxable income. Yes? Okay, both of these are examples of tax deductions. Does everybody follow me on that? Yes or no?
Yeah.
Okay, now once you have your taxable income, what do? You multiply it by your tax rate, which gives you your taxes payable. Okay? So what a tax credit does is it says, okay, we've got our taxable income based upon our deductions, we've got our tax rate that we've applied, now here are our taxes payable minus tax credit equals basically revised taxes payable. Does that make sense? Okay, that's what the big difference is. Because in one sense, if we follow through, we were to do the math on this, just real quickly, and we sort of said, yeah, we're going to have to just do another page.
Excuse me, that's at the bottom is revenue taxes payment?
Yep, revised,
Revised.
as I'm calling it. Yeah, let me just do another page, that'll be something. Okay,
Can you come back for just 1 minute?
I'm writing it down again.
Okay.
Okay, so I can put some numbers out there.
Oh, man. No, because he
Okay, so let's just do it this way. So assume that we've got net operating income of $100,000 and we've got interest expense of $10,000, 0 for depreciation, that means our taxable income is 90,000. Our tax rate is, let's say, 20%. So that's going to be 18,000. Okay? And assuming that we didn't get any tax credit, our taxes payable would be 18,000. Okay? Does that make sense, everybody?
Yeah.
Now, instead of getting the 10,000 as a deduction in the form of our interest expense, what we would see is the following. We say, well, wait up. Okay, if we don't have any interest deduction, we're actually paying more in taxes. Not necessarily. Because if that $10,000 that we got as a deduction could be a tax credit instead, a $10,000 tax credit, our tax liability would only be $10,000. So an $8,000 differential between something being a tax deduction versus it being a tax credit. Does that make sense?
Yes.
Okay? So, simply put, would you prefer to have a tax credit or a tax deduction? Credit. If it's the same dollar amount. Okay? Does that make sense, everybody? Yes or no? Okay? All right. Moving on. Now, one of the things, I got a little bit distracted there because of some of the questions, but I want to make sure that I make one other little point about this sort of marginal rate of return, because one of the things I wanted to mention was, so how do you go about calculating this marginal rate of return, okay, for a property, and how would you, sort of operationalize it? What you're wanting to do is to look at a property's performance on an after-tax basis for, let's say, year one, and compare that to its after-tax performance for year two, and say, how much of a difference is occurring between year one and year two, and then from year two to year three, from year three to year four, and so on, so that you can plot out basically this sort of a graph. Well, what is the information that you actually need to be able to do that? Okay? Well, simply put, you need 4 pieces of information. Okay? First of all, what you need is, in this case, we're going to say the after-tax operating income plus the after-tax sale income minus the after-tax sale income, and I'm going to modify this here in a second, divided by the after-tax sale income. Now, you're going to say, whoop, hold on a second. All right. This operating income and sale income for these two values is going to be, let's say, in year 2. Whereas this value is going to be for year 1, and this value is going to be for year 1. Okay? Now let's let's put some numbers in there so that you can kind of begin to wrap your head around what's actually happening, okay? Remember what I said. There's two fundamental ways a property makes money. One is off of the rental income or off of the operating income, okay? Operating income. The other way is after you sell the property, okay? So what this analysis is going to force you to do is pre-calculate for every year you own the property, what could, number one, what is the income potential off of the operating income, but more specifically, what if I sold it in that year? And every subsequent year, how much money would I make? Does that make sense? In other words, think of it like this. You own a house, or you own a building, and you know that it's worth $100,000 today, but you have the expectation that maybe it's going to be worth $110,000 next year. Well, that's a 10% increase, yes? Yes? Okay, so let's just start with that as an example. So the year two amount, sale amount, would be the $110,000, yes? The year one sale amount, in other words, the current value would be $100,000, yes? Okay, so 110,000 minus 100,000 divided by the 100,000 is going to be what? 10%, which is what I just said, yes? Everybody follow me on that, yes or no? So all we're doing is we're saying if we sold it a year from now for 110 and it's currently worth 100 and we divide that by your current worth of 100, that's going to give us a 10% rate of return, which is just what we just talked about. Yes?
Wait, I'm confused at that. Where's the operating income
Well,
coming from?
that's where I'm going.
Okay.
I want to explain this first
Okay.
because this is super easy for you to wrap your head around.
Okay.
Okay? Now, the only complicating piece, which is not that complicated, we simply say, all right, how much income did the property generate in addition to
The sale.
the sale, because it obviously had some operating income over that past year. So let's say that it generated $5,000 of after-tax operating income. Now what would you have? 115,000 minus 100,000, which would be 15,000 divided by 100,000, which would give you a 15% rate of return. Does that make sense, everybody? Yes or no?
Yes.
Okay? Very simple. Now, what that represents, that 15% in that example, that would be your marginal rate of return from owning the property from year one through year two. Does that make sense? 1 year holding period. Yes?
Yes.
So, if we want to kind of more fully operationalize this, let me do it another way. All right, so we said in this case was 5,000 was our after-tax operating income, and let me do it actually. Okay, so this is for year two. Year one, oops, just so that I'm clear and I don't confuse anybody. So the after-tax operating income, okay. So for year two, 5,000, we are, in this case, the value here is 100,000. Now it's 110,000. Okay? Does that make sense? Okay? Now, let's say for the following year, we had 8,000 as our operating income, and the property is worth, let's say, now 115,000. All right, to get the marginal rate of return, sort of following our little formula.
For year 2.
Yep, for year 2. So in other words, we're going to be using year 3 operating income. All right, adding that to the value in year 3, the after-tax sale value for year 3, subtracting out, and this is the part you're going to be subtracting out for year 2 after-tax sale, dividing by year 2 after-tax sale. Because here, now we're looking at it 1 year later. What is the benefit, the marginal benefit for owning it for that 3rd year?
So the marginal is between 2 and 3, you want to put it on.
Yeah, so in this case, so the 8,000 plus the 115,000 is 123,000 minus 110,000 is 13,000 divided by 110,000 gives us 11.8%. Okay? Now, if you remember, the previous one for year 1 to 2 was what?
15.
So it doesn't always go up. It can go down. So what's actually happening, if you sort of think about this in terms of our curve that we were sort of talking about,
We're above the,
so probably what's happening is, you know, in one sense, you can sort of look at it that it's a very short curve, that this may only be, here's year 1, here's year 2, but we're basically saying we're here 15%, now we're down here at 11.8, is one way to sort of visualize it or think about it. Does that make sense?
Yeah.
Okay? But realizing all of this can change. In other words, the market value of the property could go up or down over time, as could the after-tax income the property generates over time. Make sense?
Yeah.
All you're doing here, let me make sure I am exceedingly clear. You are simply looking at the percentage growth or the percentage change from 1 year to the next year of the total after-tax income the property is generating. Okay, this is not an overall return for the investment. This is strictly looking at it from 1 year to the next. Okay, make sense? All right, moving forward.
Professor,
Yep,
the question you would ask us would be the marginal rate of return
Exactly.
for year 2 or year 3,
whatever information I provide you.
but for this calculation.
Well, in this particular calculation, this would be for year 3, this one would be for year 2. Okay? All right, moving forward. Okay. Now, one of the things that we're going to need to do is calculate the after-tax rates of return, assuming a couple of different scenarios. One, we need to figure out, okay, for the, let's say the first 5 years of ownership that we've owned this property, let's figure out what our rate of return is there on an after-tax basis, okay? Then after we've done that, then we want to calculate 2 other scenarios, which is, what if we continue to own it, and what if we sell it? Okay? And taking into account the acquisition cost of maybe the future owner. Okay? All right, so let's just kind of run through this. And your book does a fabulous job of doing this in case you were wondering. All right, so in this particular case, for the first 5 years, all right? So let's assume in this particular case, at time period 0, $50,000 is what we paid for the property. All right? And then in each subsequent year, we got $4,000, and this is all on an after-tax basis.
Cash flows?
These are cash flows, but you can, since they're the same, they can be treated as an annuity so that you don't actually have to use the cash flow function. You can just simply use, obviously, just the payment key, okay, on the calculator. All right, and at the end of that 5 years, once again, all of these are on after-tax dollars, okay? So at the end of the 5 years, let's assume that we could sell it for $75,000. All right, so the first question, this is from you as the owner of the property, what would be your rate of return, your after-tax rate of return on this? So, you know what to do, or you should. And obviously, one payment per year.
Can't be right. We're getting 33.9.
Nope.
Yeah, it's gotta be too high.
Okay, everybody, anybody else has got an answer, let me know. I'll tell you if it's right or wrong.
In my head, it should be like 13.6.
That is correct. 15.36%. Okay? Now, how do you get that? All right? Very simply. Once again, one payment per year on the calculator. 50,000. Change the sign to make it a negative. Make that as your present value. Put the 4,000 as a positive payment. Put the 75,000 as a positive future value. Put in 5 years as your term. Solve for the interest rate or the rate of return or the internal rate of return, whatever we want to call it, and you should get 15.36. Okay? Does that make sense, everybody? Yes or no? Okay? Now that is just, now one of the things that you should be picking up on, you're just saying, wait a second, this is the same exact sort of problem that we just worked in, you know, like the first module or second module. Yes, it is, but it's a different application. This is being applied to after-tax cash flow for a different type of analysis. So the point being is this stuff gets used in different ways for different things, okay? All right, so in this case, that's just simply telling us this is our after-tax internal rate of return, okay? Everybody kosher with that? All right. Now, this is where the logic train changes a little bit, okay? So we make the assumption that in this case, actually let's do it this way. We start off with year 5, and then we go to 6, 7, 8, 9, and 10. And we make the assumption, just for the purposes of the analysis, that we sell the property, or we have sold the property, okay, in one sense. And our sale price would have been the $75,000, or that would have been the dollar amount that we would have received for the property, okay? And so we're trying to basically understand what would happen if that were the case, and that were the price that we were offered at that particular moment in time, relative to whatever the cash flows might be from that point forward. Well, let's assume that we can actually get maybe a little bit of additional rent for those next 5 years. You're saying, well, where does that extra rent potentially come from? It might just simply be you've got a new tenant willing to pay an extra $1,000 a year on their rent. And at the end of that 5 years, we can sell it for $100,000 on an after-tax basis. Okay? And all this is going to make sense here in just a moment. So what you're going to do the same thing you did up here and calculate the rate of return. But now here's the thing to sort of plug into the back of your mind just so that it makes sense to you. Really what you're doing, even though this is, for you, the ownership period of years 5 through 10, you can look at it really as if it is 0, 1, 2, 3, 4, and 5. Okay? All right? So let's do that. Same sort of thing that we did up here. 1 payment per year. In this case, $75,000.
So 11.9.
Oops. Okay. I could trust you, but I'm not going to. All right. 75,000. 5,000 payment, 100,000 future value, 5 years. Yep, you were correct. 11.92-ish%. Okay. Now that would be our after-tax IRR if we held it for an additional 5 years. Okay. So the first 5, now let's make sure that we're clear on what we're measuring and what we are looking at. During the first 5 years of ownership, our after-tax rate of return was 15.36%. But what we are doing now is we're sort of taking stock after 5 years. And we're sort of saying, what if we could have sold it to someone for the $75,000? Now this is once again the logic thing that you've got to kind of look at. If we had sold it, because that's in essence what we're just sort of saying, what is the market value, if you will? Because you remember what I was talking about earlier. What if we have price appreciation, you know, in the asset over time? How do we account for something like that? Well, that's what we're attempting to try to do here, is we're saying, yeah, we originally bought it for $50,000, but now 5 years later it's worth $25,000 more. You follow me? So if we're going to do a legitimate analysis of what it means to hold it for an extra 5 years, we've got to look at this as if we are selling it for the $75,000, because that would have been income to us. Yes? And we've got to look at what the rental rate would be. Now, we could have kept this constant. There's no question about it. We could have kept it constant, but we're just making the assumption that, yeah, we're able to get an extra $1,000 a year. And then we're also making the assumption we're going to be able to sell it for even more 5 years from now. So by doing that, we're getting 11.92%. Now, here's the thing. This is not inherently a choice between those two. That's not what this is. This is simply for us to be able to say, if we sold it for 5 years, we would have gotten a higher, on average, rate of return than we would have gotten had we held on to it for another 5 years. Our rate of return would have actually declined our rate of return on an annual basis. Does that make sense? Okay?
So the question,
Because, like for example, let me make sure this is also clear. What if our hurdle rate was 15%?
so we don't hold it.
You don't hold it. That's as simple as it gets. You sell it pretty much right after that first 5 years, because if you hold on to it for another 5 years, you're not meeting your hurdle rate of 15%. That's the lesson in this first piece of the analysis. Does that make sense?
Yes.
Okay? Now, the next piece of the analysis is to look at it as if somebody else is potentially buying it, okay? And what maybe their assumptions are. And so, all right, let's look at it like this. Okay.
Professor Forgy, I don't understand why the after-tax IRR is 11.9%, because you're only taking in the calculator the 5 years.
Mm-hmm.
I mean, only 5 years, not 10 years. So
Correct.
How is
Now, if we were to combine the two,
possible?
we could combine the two and get an overall rate of return on an annualized basis for 10 years. But my suspicion is what you're going to find is it's going to be somewhere between the 15 point whatever 36 and the 11.92.
It's 13.89.
There we go. Okay. So what that's basically saying is at some point during our ownership, we're no longer meeting our hurdle rate. Okay? Now, I've tried to make it simple in the sense that I've already kind of predetermined it's really after 5 years.
Right.
Okay? All right. Now, let's move on. Now, this is we retain ownership in one sense. That's that. Now, in this case, new purchaser. All right? And so we've got 5 years of analysis for them. All right? Now, they bought it from us for the $75,000. Yes? Okay? But here's a wrinkle. What might they do at the time of ownership if you're a new buyer? Renovations. Okay, so let's say that they have $25,000 of renovation cost. So we would want to add that in. Okay, which would equal basically a negative $100,000 total. Does that make sense? And I probably should, we're trying to do our signs correctly, we really should sort of say plus minus the 25,000.
So it's basically acquisition plus renovation?
Yes, acquisition plus renovation. Okay, but what does that probably mean for them with regard to the rents they're going to be able to charge?
Higher rents?
Higher rents. Okay, so maybe they're able to get what? $6,000 a month or a year. I mean. Okay. And then at the end, they're able to sell it maybe for $125,000. Okay. They bought it in total for $100,000 because they put $25,000 of renovation in it. They're going to eventually be able to sell it for $125,000. So in one sense, here's another way to look at it, just to kind of keep things in perspective. With our ownership structure, we only have we only have $75,000 as our original purchase price, and we end up selling it for $100,000. They're putting an extra $25,000 in, meaning $100,000 in, but they're actually only getting really $25,000 more than what we were getting. So in other words, you can sort of look at it, the real benefit of those $25,000 of renovations is not flowing through into the capital gain, but what is it flowing through to? The rental income. But just eyeballing this, and this is where I'm trying to get you to sort of think about this. Just eyeballing this, they're only getting $1,000 a year more, which translates into how much total additional income? $5,000. So you can probably, without even doing the calculations on this, can probably make the assumption that it probably wasn't worth those extra renovation costs. Does that make sense? But let's go ahead and figure it out just to see if that's the case. All right?
That's not legit. 10.0.
So 100,000, present value, 6,000 as the payment, 125,000 as the future value, 5 years as your term, solve for the rate of return. Okay, so let's see what we get. Okay, I got 10.8,
Yeah.
10.08 I mean.
87.
10.087 or keep carrying it out however long we want to, okay? So the point is, strictly from a rate of return perspective, they, as a new purchaser, are worse off than we would have been had we owned it, but we would be better off just selling it after the first 5 years. Does that make sense?
Yeah.
So in other words, now, once again, all of these assumptions, I mean, we change up the assumptions. This is what I guess, what I don't want you to put into the back of your head is, it's bad to buy a property and renovate it. Because what if the assumptions were different? What if the income was substantially higher than this after the renovation? What if the eventual selling price were higher? That would change everything.
Well, that's what happened on between case 1 and 2. I mean, the drop is not just because the income is the amount of income didn't increase enough to the amount of investment.
Or the amount that we would have achieved if we had sold it. That's the thing that you have to sort of keep in mind, that the reason for this analysis like this, and having the 75,000 here instead of the original 50, was to take into account the fact that we could have sold it for that 75,000.
Right.
So if we had have, this would have been our rate of return. Now, the more common thing would have been to simply just sort of almost ignore that and just to calculate a rate of return over the entire holding period. But that doesn't get at what we're trying to actually ascertain, which is if we should sell it or not. Okay, that makes sense? Thoughts, questions, observations? Okay.
Professor.
Yep.
You know, in the first, you gave us handouts for chapter 3 and 4 with really good questions. The chapter in the book, it has a lot of information.
Yes, it does. That's why you focus on what we cover in the lecture.
Okay, so your questions on the quiz, the next quiz would be more so with like these calculations?
Absolutely. Absolutely. There's no secrets. Yep.
Why are you making a reference to after-tax IRR on that?
Because that's what it is. It is the after-tax, in all cases, this is using the income the property is generated on an after-tax basis, both in operations as well as if we sold the property, what it would sell for after we've paid all of our income taxes. And the reason for doing that is that, once again, from a disposition, renovation perspective, you always need to look at it on an after-tax basis. Okay? The calculations, the actual plugging it into the calculator is not going to change whether it's before tax or after tax. But what the numbers represent changes. Okay? All right. So we've got a couple of other little things to talk about on the 14 stuff. All right. Installment sales or installment sale contracts. One of my favorite things to engage in. All right. So let's assume that you own a property, and you pretty much own it outright. In other words, maybe you don't have any debt on it. One of the things that you might consider is offering up an installment sale contract, or otherwise known as owner financing. Okay? Now, what this means is, assuming that I own the property free and clear, and I say to you, all right, I want to sell you this property, but then you say, you know, maybe, you know, I don't have enough of an income history, or, you know, I'm having difficulty getting a loan from the bank, whatever the case might be, and I say, okay, no problem. I'll sell it to you in an installment sale contract. And in other words, it's kind of like, the easiest vernacular for people to sort of relate to is lease to own, okay? But, you know, it goes a step beyond leasing to own, in the sense that you are making, you know, maybe additional payments to cover, in essence, the overall principal, you know, on the actual loan. Now, let's talk just a little bit about why you would do this, and then show a couple of different calculations associated with it. Why would I, as the owner of the property, want to offer seller financing or owner financing to a prospective purchaser?
A higher interest rate.
I might be able to charge a higher interest rate, but we'll go with that maybe as a possibility. What else?
Defer taxes.
I'm sorry?
Defer your taxes.
Okay, the big one that we're going to be dealing with is about the tax issue. Okay, what else? I've got a steady stream of income. Okay, for many years it basically made my retirement fund. Okay, what else?
If they don't pay,
But I know,
take
but
it
think
back.
about it like this. When you say the steady stream of income, let's say that I sell this thing whenever I'm 50. Okay, and I set up a mortgage based on an installment sale contract for 30 years. Well, that basically is going to be making income payments to me for the next 30 years, and I'll be 80 years old, you know, by the time that that thing is done, and hopefully at 80 I just drop dead. Okay, it's all very simple, very well planned. All right, now.
I have a feeling you're gonna die on that day then.
I feel like it. Okay, I'm working toward it. Let's put it that way. All right, so you have the installment sale, and because it is a reason for living, you know, you have installment sale and money coming in. But no, seriously, okay, so you set this up. What are the other benefits for me as the owner of the property?
You can take it if they don't pay it.
Yeah, it's a much easier foreclosure process because it's really not a foreclosure. It's a situation of, because you don't actually convey the title. You don't give them a deed. What you give them is, in essence, a contract that simply says, you make all these payments for the next 30 years. At the end of that 30 years, I then convey to you the title of the property. If you miss payments over that 30 years, then I have the right to take repossession of the property, which I've never really given up. I'm still the owner of record. Okay, does that make sense?
Right.
Okay? Now, what is the benefit from the buyer? What, I'm sorry? They don't have to deal with the lender.
You may get a lower interest.
I could make it a lower interest rate if I chose to, but I don't have to, because one of the things that you're giving up as the buyer is you're not going to have to go through all the brain damage of going through the lender. You're not going to have now I'm not saying you shouldn't have to go through and get an appraisal or an inspection or, you know, any of the due diligence sorts of things that you would ordinarily have to do with a normal purchase, but you don't have to do those things. And it can be less money down or even no money down. Because if my perspective is very simple, all I'm looking for is a fixed income stream for the next 30 years. All I really care about is getting that dollar amount and not having to worry about the day-to-day sort of operations of the property per se. Now, granted, I'm still going to probably want to do an inspection every now and then to make sure they're not destroying the property or not maintaining it or, you know, things like that. But, you know, outside of that, you know, I'm not going to have to worry about being there to collect the rents, being there to pay the utility bills, being there to pay the property taxes, and yada, yada, yada. Okay, make sense?
Can you, this is kind of off track, but on
Don't
track.
get too far off.
Imputed interest. So how can you,
Imputed interest, it's sort of, that's really more of a San Miguel question for the accounting class, but I'll give you the short version. Okay, basically imputed interest, it's the IRS typically is going to look at these transactions and they're going to say, is this in essence an arm's length transaction? And if it looks as though it's a situation of where you're basically inflating or deflating what would ordinarily be a market interest rate, the IRS is going to potentially give that some attention. And it could be problematic for you at some point in the future. Okay, that's the simple short version.
so they can add an interest rate, tax you on what interest rate should have been there?
Yeah.
Okay.
Okay. All right. Now, with this sort of installment sale, one of the things that you've got to do as the owner of the property is that you have to compute basically what is sort of the profit or the capital gain that you would have received off of this property and allocate that over the life of the installment sale. Okay, now, explain what I'm saying. Let's say I bought the property, the original owner, I bought the property for $100,000. But subsequently, I'm selling it to you for $150,000. Okay? So technically, all other tax implications pushed aside, all other calculations pushed aside, the capital gain to me would be what? $50,000. Yes? Okay. In an ordinary sale, not one of these, in an ordinary sale where I just simply sell the property to you, what would take place is I, at the time of that sale, would have to pay capital gains tax on that entire $50,000. Does that make sense? Yes or no? Okay. But with an installment sale contract, one of the beauties of that is that I get to allocate that gain over the entire term of the installment sale contract. So, if the installment sale contract were 30 years, like we've described, what we're basically saying is we would take that $50,000 gain and divide it by 30 years, would be $1,667 of gain per year, with it would then be taxed at the capital gains tax rate. Does that make sense? Yes or no? So instead of the full $50,000 being taxed immediately, I'm getting to defer the taxation and have it allocated over the next 30 years. Does that make sense?
Yeah,
You're still having to pay it.
yeah.
It's just that you're deferring it in the sense of over the life of the installment sale contract.
So if they sell it, let's say that the guy decided to buy it right after the other person, it will be divided.
Okay,
into-
now, all right, you're complicating it, so, but I'll explain. So what if the person that I sell it to in this installment sale contract says 5 or 10 years into it, they want to exercise their right to go ahead and buy out the remainder of the contract. Okay, they could do that. What that would mean is then they would have to give me the full remaining dollar amount, whatever that might be, without trying to calculate it, right then and there at the end of that period. Now, if I agree to that and we do that, then I would be liable for whatever remaining capital gain tax has not yet been paid at the time that would occur.
Can you pass that through to the buyer in a prepayment clause?
You could. You can do almost anything. But yeah, that's one way to approach it.
If the buyer accepts, right?
If the buyer accepts. I mean, once again, all of that legal work would need to be done up front. okay, as to what, you know, the ramifications would be if they choose to buy it out early and so forth, so on. Whether you, in essence, have a prepayment penalty clause or not, okay? All right, now, so let's just sort of take and say that we've got, in this sort of a situation, we're going to work through another example here. So we've got the case of an asset was worth $1 million. The time that we purchased it, the original sale price, I'm sorry, the sale price of the asset, time of sale, is $1 million. And specifically, the adjusted basis of the property, and you can sort of look at the adjusted basis as sort of like this was our original purchase price. Now you're saying, well, and we'll say that's $800,000, just for simplicity's sake. All right?
800,000 is the
adjusted basis, okay, or what in essence maybe we paid for the property
Okay.
at some point in the future, or sorry, some point in the past.
Okay.
All right? Now, what that means, just in a simple calculation, this would be referred to as our gross profit. And that would be $200,000.
Yeah.
Okay? Once again, all this is in the book. All right. So the sale price, we subtract out what we originally paid for it, or what our current adjusted basis is in the property. Now, why do I use the term adjusted basis? We'll get into that later. Adjusted basis is simply a tax nomenclature, or in other words, just simply saying, here is what the property is worth from the IRS's perspective. Okay? 800,000. So the gross profit would be 200,000. Okay, everybody cool with that? Yes? No? Possibly could be. Okay. Now, in addition to that, we need to do another little calculation. All right? And here, let's say that we've got a mortgage of $700,000 on the property. Okay? And our sale price, once again, was $1 million. Whoops, another zero in there. Okay? So we need to subtract out the mortgage that we still owe, if this is a situation where we actually still have a mortgage on the property. And that would give us a $300,000 what? We're going to call, or what the text calls it, basically a contract price. Okay? Because in essence, we don't get that much. I mean, we get the 300,000, we don't get the 700,000, is what we're saying. Okay? All right. So, on the property, these are two separate calculations. That's why I drew a big line between them. This first one is to determine overall what is the gross profit on the property. This second